I know that the next phase of the bear market has arrived and is going to get much worse, going to intensify rapidly, and that's when I'm adding shorts to the portfolio. Don't forget, when you short stocks, it's a very dangerous game. It's very hard to be right. It's very expensive. And
Join us for an insightful discussion with Michael Pinto, president and founder of Pinto Portfolio Strategies. As we delve into the dynamics shaping today's markets, discover his compelling insights on the potential for stagflation or depression post a 2024 stock crash, the fate of the dollar, and strategies to safeguard wealth amidst market turmoil. Tune in for a thought-provoking exploration of the financial landscape ahead.
it's a slow motion train wreck. And that's sort of displayed appropriately if you look at the averages. So, the Russell 2000 is down, I think, 33% from its high that it posted at the end of 21. NASDAQ's down 13%, S&P's down 12%. So it's a bear market. And bear markets aren't linear. Lots of bear markets have huge bounces. I expect phase 2 of the bear market to commence very soon. We had the massively strong GDP print, 4.9%, according to the BEA. I think that's mostly just undercounting inflation. I mean, that's 4.9% real GDP. It's probably closer to 2 if you counted inflation correctly. But you see a lot of things underneath the surface are really eroding quickly. You see the leading economic indicators have been heading towards recession for a year and a half. That hasn't changed. The NFIB survey says recession. Inverted yield curve says recession. Delinquencies and defaults are rising. I have a bifurcated market. Most of it, I'd say the top 2 quintiles are doing fine. The 1%ers and a little bit below that. And then you have the bottom 3 quintiles that are broke, have no savings, less than $1,000 in the bank, and living paycheck to paycheck and getting killed by inflation. And then you also have the reverse wealth effect kicking in too. If you owned a bond, Anthony, if you owned a bond and it wasn't where we are, which is like really 0 to 3 years in duration, so the shortest end of the yield curve, get wiped out. If you owned extended duration bonds, you're down 60% in the past 2 years. And even if you just own 20-year plus, you're down 45. So it's been a train wreck. Everywhere you look has been a train wreck in the markets. There's been no place to hide. The only place to really hide is if you look at hide is maybe AI stocks, a couple, the Magnificent Seven, they call them. But even if you look at the NASDAQ, which includes the AI, the big parking place for all this wealth, they are down, as I said, 13% in the last 2 years. So there's over the last 2 years, which is the peak of the cycle, there's been no place to hide. On the other end of this, you're going to see economic gravity take hold. Money supply is shrinking. If you look at the lagged effects of 525 basis points of hiking, QT kicks into high gear in March when the reverse repo facility runs dry. So I think we're going to have a very, very tough 2024. And the way you survive that is by owning lots of cash, lots of treasury bonds, because now they have a place to rally from. When treasury bonds yielded 0, Anthony, the price couldn't really go much higher. I mean, it could only go down. Well, now you have a nice, juicy, fat yield, 5% almost across the entire yield curve. That yield can go back towards 2%. And I think you can make a lot of money in bonds. And then, of course, if you own the US dollar like we owned in the last 2 years, I think you'll do fine. You'll do fine in this next recession. You could not only not lose money, which is crucial when you invest, it's crucial not to take steep losses. 30, 40, 50% in the portfolio, like you did in 2000, 2008, 2020, 2022. So you have to preserve your principal, make some money in bear markets, and get ready and well positioned to make money on the other side of this bear market, which I think is going to be a very stagflationary exit. I want to see financial conditions begin to tighten. So far, they've actually been loosening over the past few months. I want to see those financial conditions begin to tighten. And lastly, I would like to see high yield spreads to treasuries start to blow out a little more than they are now, which is like 4.37%, which is not, it doesn't flash a warning sign. I know that the next phase of the bear market has arrived and is going to get much worse, going to intensify rapidly. And that's when I'll adding shorts to the portfolio. Or don't forget, when you short stocks, it's a very dangerous game. It's very hard to be right. It's very expensive. And you got to do it correctly. So you have to be in and out of these shorts. You have to get the timing right. And that's what I'm going to do. I'm not going to force the market. I'm not going to force the market to do something it's not ready to do. And that's how you lose a lot of money. So when the economy is ready to go over the cliff, I'll know and I'll get out. Well, everybody else is saying, oh, it's an aberration. Consumer is strong. Don't bet against the American consumer. Consumers are flush with cash. Businesses have deleveraged. Public debt doesn't matter. Blah, blah. I mean, I can go on and on with all the platitudes that you'll hear from the permabulls who are paid to say things to get the market go up because that's what they do. They sell bonds, corporate bonds, and they do IPOs and they make money when the market is bullish. I don't do that. I mean, I make money both ways, long and short the market, currencies, commodities, equities, international, whatever, wherever I think my money and my clients' money is going to be treated best. That's where I go. That's easy to do when inflation is quiescent or below the Fed's asinine 2% target, as if the economy can't function with a 1.5% inflation rate. We could talk about that if you wanted to. But when inflation goes from below 2% for many, many years and then goes to 9%, and that's the way the BLS measures it, the Labor Department. If you measured it accurately, it's closer to 20%. Then you got an inflation problem. In other words, the market is losing faith in your ability to provide a real return for investors to vanquish inflation. The interest is $720 billion a year. That's going to, just because interest rates went from 2.5% average interest rate to, I said 1.5 to 3, we're going to be paying an extra $800 billion. So you're talking about $1.5 trillion in interest payments per annum. Well, you got a problem if you're the Federal Reserve. If you're the Federal Reserve and your playbook now says, I am now going to paper over all this recession and the bear market by just flooding the market with money, reserve, the banking system with reserves. I'm going to lower interest rates. And the Treasury is going to do another round of helicopter money. Well, I mean, who's going to be fooled? What investor is going to be duped into thinking that the Fed or the Treasury is going to allow markets to function freely and allow interest rates to rise to a level that provides a real interest rate? Nobody's going to be fooled anymore. When the average portfolio was down 20%, equity portfolio, you look at the 60-40 portfolio and you say, well, I would hope that the bonds would would offset that. That would be a ballast to the portfolio. As I mentioned before, bonds weren't a ballast. They exacerbated. It was pro-cyclical there. They just exacerbated the drubbing that you took in equities. So I think at this point, the AG, which is the investment grade bond index, is down 23% from its high. That includes all investment grade bonds. But as you go out along the yield curve, that drubbing could have been 60%. You look at extended duration. But that's what happens when yields are zero and the bond market is ripe for a collapse. I think and the next time we have a recession, which is 2024 on the schedule, you'll see stocks fall, but bonds will give you a ballast because they have that level of safety now. You can't rally interest rates lower from virtually zero. There's just not much room to go. But from 5%, there's a lot of room to run there. So yes, they will offer a ballast, but you got to be careful now because there'll be a truncated period of time that you can invest in duration, in my opinion. Because once the Fed starts to reliquify the money markets, then you're going to have a problem with duration. You're going to have a supply problem and you're going to have an inflation problem. So I think the long run yields are going much, much higher.
Thank you for joining us in this illuminating conversation with Michael Pinto. Remember, in uncertain times, informed strategies pave the way for safeguarding your assets. Stay tuned for more expert insights and actionable advice to navigate the evolving financial landscape. Don't forget to like, share, and subscribe for future updates. Until next time, take care and stay financially empowered.